Okay guys, today's topic we'll talk about distributions to the shareholders, dividends and repurchases. We'll talk about theory of investor preference, signaling effects, residual model, stock repurchases, stock dividend and stock splits, and dividend reinvestment plans. So here is your job, right? As a CFO, you need to maximize the value of the business or the firm. One of them, you look at the yellow arrow, right, is to make the decision regardless of dividend, right, or the dividend decision. So if you cannot find the investment, right, that makes your minimum acceptable rate, or WACC, right? Please return the cash to the owner of your business or investors, right, to your business. If you cannot find investments, how do you know you cannot find good investment? Good investment NPV must be positive, right? IRR must be greater than WACC. So you look at the component of dividend decision. You need to know how much cash you can return, right? Depends on current and potential investment opportunities, right? If you have good project or not, right? And how you choose to return cash to the owners will depend whether they prefer, investor prefer dividends or stock buybacks. So when the firm generates cash from operations, right, EBIT after tax plus depreciation, what can the firm do with the cash? Number one, use the cash to fund new investments if this is a good project. Number two, use the cash to pay off some of its debt, right, and or distribute cash back to the firm's shareholders, either as the cash dividends or stock buyback. Here is the step. Once you get cash flow from operations, you need to ask yourself, how much did you borrow? Right? You return cash flow to the debt, right? Principal repay and interest expense to bondholders. And whatever left is the cash flow from operation to equity investor. Second question that you need to ask yourself, how good are your investment choice, right? If you have good investment, you need to reinvest back into the business. And whatever left, once you invest back to the business, whatever left is the cash available to return to shareholders. And the next question that you need to ask yourself, what is the reasonable cash balance, right? You need to know your target cash balance, right? It's the cash held back by the company. So you need to be able to calculate the optimal level of cash and the minimum level of cash, right? So that you held back by the company. And whatever left, you go pay out to investor, common stockholders, right? So you need to ask your last question, what do your stockholders prefer? They prefer buybacks or they prefer dividend? So you need to set up the dividend policy, right? Or distribution policy. The distribution policy defines, number one, the level of cash distribution to shareholders, the form of distribution, dividend or buyback, the stability of that distribution, right? So here is the dividend yield, right? What is dividend yield? It's the dividend payment divided by market price, right? Dividend yield as a selected industry. As you can see, right, tobacco, electric utility, dividend yield is very high compared to software and programming, right? Dividend yield is very low. Why is that? Because tobacco and electric utility is reaching maturity already. They don't need cash to reinvest, right? With the new project, right? It's not growth company anymore, right? Unlike the programming industry, right? They still need cash to reinvest, right? Because they want to grow up, right? So dividend yield will be much lower than the maturing firm, right? And you see more and more firms are buying back the stock rather than paying dividends. You see the green color is a trend, right, for buyback compared to paying dividend. Paying dividend is pretty flat, right? They try to maybe stabilize the dividend payout, right? Unlike the buyback, right? It's the swing a lot is more fluctuated compared to dividend, cash dividend. So here is two different vocabulary, different meanings, right? Don't get confused between dividend payout and dividend yield. Dividend payout is dividend, right? Dividend per share divided by earning per share. Okay, but dividend yield is dividend per share divided by market price per share. They're not the same. And here is the again, right? It's a picture of life cycle, right? So this is life cycle analysis of dividend policy. We have like 5 stages, right? Number 1, startup. Number 2, rapid expansion. Number 3, high growth. Number 4, mature growth. And number 5, decline. The firm start to pay dividend if they start to have positive cash, right? So when should it be? Stage 3, right? High growth, right? So once they have positive cash flow, right, they might start to think about paying dividend or buy back the stock. So if the company, this is very important rules, if the company has excess cash, what does it mean, excess cash? Actual cash balance greater than optimal plus minimum, and few good investment opportunity, you have very few good investment opportunity. Returning money to stockholders is good, right? Dividend or stock buyback is good. But if a company doesn't have excess cash, and or has many good investment opportunity, returning money to stockholder is bad. Okay, you need to memorize this concept. So there are 3 theories that relate to how do you make decision about dividend policy. Right? Number 1, dividend are irrelevant theory. Right? Investors don't care about payout. Get the payout or don't get the payout or buy back doesn't matter. Number 2, bird in the hand. Investors prefer high dividend payout. They prefer cash dividend. Number 3, tax preference theory. Right? Investors prefer low cash payout. Therefore, they prefer growth. Right? They want the firm to keep money and reinvest the business, right? Or maybe buy back rather than paying cash dividend. So irrelevant theory, the first one, investors are indifferent between dividends, right, and retention generated capital gains. When you buy back the stock, you get capital gain, right? The firm buy back the stock, they have to use their own cash to bid up the price from the market, right? So once they keep buying, the price will be up. So you get capital gain. If they want cash, they can sell stocks. If they don't want cash, they can use the dividend that they receive, right, to buy back the stock by themselves. Okay, so this theory is based on unrealistic assumption, no tax or a transaction cost, right, brokerage fee or something like that. A bird in the hand theory, right? Investors think dividends are less risky. They prefer to get cash dividend for their living, right? So they like dividend. If so, investor, this kind of investor we call income investor, would value high payout firm more highly, right? That is what high payout would result in higher PCO. If the firm decide to pay more dividend, this guy, right, this income investor will come and buy more stocks, right? And the price will be up. On the other hand, tax preference theory, this one is growth investor or the investor that prefer buyback, right? Low payout means higher capital gains. Capital gain tax are deferred, right? Are deferred. In Thailand, capital gains tax 0, right? 0%. This could cause investor to prefer firm with low payouts, right? That is the high payout result in the low value. If the firm keep paying with high payout ratio, they will sell the stock, right, and go somewhere else, so the price will drop. Here is again, right, theory, irrelevance, any payout is okay. Bird in the hand, set high payout, right? Firm should set high payout. The tax preference, the firm should set low payout ratio. What is the signaling hypothesis? Investor view dividend changes as signals of management view of the future. Manager hate to cut dividend, right? If you're an income investor, you know, manager will hate to cut dividend. They hate to inform those investors that we will cut dividend. So they won't raise dividend unless they think raise is sustainable. Therefore, a stock price increase at the time of dividend increase. Why? Because manager believe they have ability to sustainable the higher dividend, right? So that the market price will increase, right? Because more income investor will jump into and buy the stocks. Clientele effect, and different group of investor or clients prefer different dividend policy, right? So clientele effects impact changing dividend policy. You see, with the high tax bracket, investor may invest in the stock which do not pay dividend, because if they get dividend, they have to pay with the higher tax dividend rate, higher tax rate, right? Once they receive dividend. And the study show that the older investor were more likely to hold high dividend stock, and poorer investor tend to hold high dividend stock. They use the 914 samples, right, to run regression between dividend variables, which is dividend yield, against independent variables, right? Number one, beta, age, income, tax rate. As you can see, right, the coefficient, you see the age, right? Coefficient is 3.13. So what does it mean? Firms with older investor pay higher dividend, right? Older, they want to get higher cash dividend. You see income coefficient is negative 3.726. What does it mean? Firm will wealthier investor pay lower dividend, right? So if they're richer, they try to get lower dividend. And the tax, right? Just like before, just like Warren Buffett, right? He loved the stock that, you know, keep buying back rather than paying cash dividend. And tax rate, you see, if you pay high tax rate, you prefer the firm not to pay cash dividend because you have to pay high tax, right? And here is a survey, right? That, you know, that they did with the CFO, right? Opinion. They try to find the opinion regardless of dividend policy. You see, majority of the CFO say the same thing. They try to avoid reducing dividend per share. Okay, this is a big thing, right? If you reduce dividend per share, income investor will leave, right? And it costs the sharp drop in price, right? And then they also agree, right? They try to maintain a smooth dividend from year to year, right? So that they can create confidence to income investor. Just like this, right? They 84.8%, right? They try to maintain consistency with the historic dividend policy. Okay, they don't want to keep changing the dividend, right? If you're income investor, you understand, right? You need the fixed income with the fixed, maybe not to vary much about what the dividend payout, right, for your living. So the firm understand that. They try to maintain the consistency with the historic dividend policy. Thank you.